Welcome everyone to Everything You Need to Know About Finance. Today we're doing a deep dive into Nvidia Corporation's recent financial results. We're looking at their first quarter for fiscal year 2026, the period that ended back on April 27th, 2025.
That's right. And we're going straight to the horse's mouth for this one. We'll be unpacking everything based on the company's own Q1 FY26 CFO commentary and their official 10Q filing. These are the documents where you find the real numbers and, crucially, the context NVIDIA itself provides.
Exactly. Our mission here is pretty straightforward. Cut through any noise and really pull out the key insights from these docs.
Yeah.
We want to understand what actually happened last quarter, what drove those results, and importantly, what the company seems to be signaling for the near future, based on their own words.
And just a quick but very important note before we jump in. This deep dive is purely about presenting and analyzing the information shared in NVIDIA's official financial documents. It is absolutely not financial advice. Think of it as us breaking down the report for you. You should always do your own research or talk to a financial professional before making any investment decisions.
Couldn't agree more. And one piece of context from the sources that's useful right up front, remember that 10-for-1 stock split that was effective June 7th, 2024. So all the per-share numbers we'll talk about today have been adjusted in the documents to reflect that split. Helps make sense of the figures.
Good point. And the sources also detail their ongoing share repurchase program, which, factors into their overall financial activities.
Yeah.
Okay, so ready to dive into the headline numbers, the big picture for Q1.
Let's do it. The revenue figure definitely jumps out first. $44.062 billion. The sources really emphasize this. It's up 69% from the same quarter last year. 69%. And still up 12% from the prior quarter.
Yeah, massive top-line growth. But what's interesting is the gross margin story. The GAAP gross margin was 60.5%. Now that's, quite a bit lower than the last quarter, 73.5%, and even more so compared to the 78.9% they had in Q1 last year.
Whoa, okay. That's a noticeable drop in margin percentage, especially year over year. What did the documents say was behind that?
They're very clear about it. The main thing was a really substantial charge. They took $4.5 billion. It was specifically for excess inventory and purchase commitments related to their H20 product.
Ah, okay. The H20 products.
Right. They also mentioned some costs tied to the initial ramp-up of their newer, more complex systems in the data center segment, getting those sophisticated setups going. Just for context, they do provide a non-GAAP gross margin figure of 71.3%, which excludes that big H20 charge. So you can kind of see the underlying performance versus the impact of that specific charge.
Got it. So huge revenue, but that $4.5 billion charge really weighed on the reported GAAP margin.
Yeah.
How did things look further down the income statement, operating income, net income?
Operating income came in at $21.638 billion, and net income was $18.775 billion. Now, these were down sequentially from Q4, which was, a monster quarter, but the year-over-year growth compared to Q1 of FY25 is still really, really strong.
And earnings per share, reflecting that, I assume.
Exactly. GAAP diluted EPS was $0.76. Again, down a bit quarter over quarter, but way up year over year. And the source also gives that adjusted EPS number, $0.96 per share, if you back out the H20 charge and the related tax effects.
Okay, that gives us the overall financial snapshot. But let's break it down. Where is this revenue actually coming from? Which parts of the business are firing?
Right. If we look at the segments, it's pretty clear where the action is. Compute and networking is still the absolute powerhouse. It brought in $39.589 billion in revenue. That's up 10% just from the previous quarter, and a massive 75% year over year.
75%. Okay. And what about the graphics segment?
Graphics reported $4.473 billion, still a big number, and it also showed really strong sequential growth, up 36%, and up 33% compared to the same time last year.
So both growing nicely. But digging into that compute and networking number, what specific markets are driving that, especially in the data center space?
Yeah, data center is really the story here. $39.1112 billion in revenue just from data center, up 10% sequentially, up 73% year over year. The sources say it's driven by, well, exactly what you'd expect. Huge demand for accelerated computing. They call out large language models, recommendation engines, generative AI, agentic AI applications, the whole spectrum. And interestingly, they note the ramp of their new Blackwell architecture isn't just hitting the huge cloud providers anymore. It's expanding out to consumer internet companies and regional cloud service providers, too.
And within data center, they split out compute and networking revenues, don't they? What did that show?
They do. So compute revenue was $34.155 billion. Still massive growth, up 5% sequentially, 76% year over year. But the real eye popper was networking revenue, $4.957 billion. That jumped 64% sequentially, 64% in one quarter.
It was driving that big networking jump.
The source links it directly to their NVLink interconnect technology being adopted in those new GB200 systems. And also just broader adoption of Ethernet solutions for these big AI clusters.
Makes sense. The systems need faster pipes. What about gaming this quarter?
Gaming came in strong, too, $3.763 billion. That was up 48% sequentially and 42% year over year. The documents attribute that mostly to sales kicking in from the Blackwell architecture in the gaming sphere.
Right.
They also touch on professional visualization and automotive driven by things like Ada RTX workstations and their self-driving platforms. But, they're much smaller pieces of the pie compared to data center and gaming right now.
And the 10 key filing usually mentions customer concentration. Did it this time?
It did. It pointed out two specific direct customers, just called Customer A and Customer B. They accounted for 16% and 14% of total revenue, respectively. And importantly, both were in that powerhouse compute and networking segment.
Okay, so two big direct buyers.
Yeah. And they also estimated that two indirect customers, meaning folks who buy through partners, maybe even including customers A and B themselves, also represented 10% or more of total revenue each. Again, primarily in compute and networking.
So a significant chunk of that data center growth is tied to a relatively small number of very large end customers.
That's what the filing suggests, yes.
All right, let's shift gears a bit. Beyond revenue, what about the operational side? Costs, the balance sheet, cash flow?
Sure. Operating expenses, the GAAP number, were up about 7% sequentially and 44% year over year. The main reasons given were pretty standard for a growing tech company. Higher compensation and benefits from hiring and raises, plus increased costs for compute, infrastructure, and engineering development as they push out all these new products.
Okay. And there's usually an other income and expense line item. What was in there?
Right. That captures things like interest income on their cash pile and gains or losses on investments. Interest income was healthy, $515 million, up nicely because, they have more cash and securities. However, overall, they reported a net loss of $175 million in this category for the quarter.
A loss. What drove that?
The source points mainly to unrealized losses and volatility in some of their publicly held equity investments. They specifically called out stakes in companies like CoreWeave and ARM. These paper losses were partly offset by some gains in non-marketable securities, but the volatility in those public stocks pulled the category into the red for Q1. Shows the risk there.
Definitely. Turn to the balance sheet itself.
Yeah.
Any key highlights?
Well, the big one is their cash position. Cash equivalents, and marketable securities ballooned to $53.7 billion. Just a huge amount of liquidity. The documents basically say this reflects the massive revenue coming in, even after accounting for the money spent buying back stock.
And inventories. You mentioned the H1 charge earlier. That must tie in here.
Exactly. Inventories increased to $11.3 billion. And the filing explicitly notes this includes that $2.3 billion inventory provision we talked about, which hit the cost of revenue in Q1. And $1.9 billion of that provision was specifically for those H20 products, essentially writing down the value because they don't expect to sell them at full cost, likely due to market changes or obsolescence. That directly hit the gross margin.
Makes sense. What about future purchase commitments? That number sounded large.
It is pretty substantial. Total future purchase obligations were $43.5 billion at the end of the quarter. That breaks down into roughly $29.8 billion committed for inventory, supply, and manufacturing capacity. They note this increase is driven by securing what they need for the Blackwell ramp.
Okay.
And the other $13.7 billion is for non-inventory stuff. A big chunk of that, $10.6 billion, is for multi-year cloud service agreements, which they expect to use for R&D support and their DGX cloud service. So big future spending commitments.
How did the cash flow from actual operations look?
Incredibly strong. $27.4 billion generated from operating activities in the quarter. Big increases both year over year and sequentially, mainly driven by that higher revenue and timing of collections. They did add a note, though, that they expect a pretty significant jump in the cash taxes they'll have to pay out in Q2 related to estimated federal and state payments.
Good detail. And finally, on the cash front, how much went back to shareholders?
In Q1, they returned $14.3 billion to shareholders. The vast majority, $14.1 billion, was through share repurchases. The remaining $244 million was cash dividends. They even noted buying back More shares, another $2.3 billion worth just after the quarter ended, between April 28th and May 23rd.
Wow.
And as of the end of Q1, they still had $24.3 billion authorized for future buybacks. So a very clear focus on returning capital.
Okay, so that's a solid look back at Q1. Now let's pivot to the future. What outlook did the company provide in these documents?
Right. For the current quarter, Q2 of fiscal year 2026, they're guiding for revenue of $45.0 billion plus or minus 2%. But here's the really critical piece. The source explicitly states this outlook already reflects an estimated loss of approximately $8.0 billion in H20 revenue.
$8 billion just from H20 due to the export controls.
Exactly. That's the
Yeah.
direct impact they're forecasting for Q2 from those specific product limitations. It really highlights how significant those controls are for their business right now.
That's a huge number. What about gross margins for Q2? Are they expecting improvement after the Q1 hit?
They are projecting improvement there. The guidance is for GAAP gross margin around 71.8% and non-GAAP around 72.0% plus or minus 0.5%. So it suggests that big $4.5 billion H20 inventory charge from Q1 isn't expected to repeat at that scale. They also mention, kind of longer term, a goal of working back towards gross margins in the mid 70% range later this fiscal year.
Okay. Beyond the specific Q2 numbers, the document spent a lot of time discussing potential challenges and risks. What stood out to you there?
What's really striking is just how much emphasis they put on external risks, things kind of outside their direct control. Export controls are a massive focus. The source goes into quite a bit of detail about how complex and shifting these restrictions are, particularly impacting China, but also affecting products globally.
And that $8 billion forecast hit is a prime example.
Precisely. They use that H20 situation as a concrete case. They talk about risks of more restrictions coming, competitive disadvantages, the sheer compliance burden, potential supply chain disruptions, specifically mentioning Taiwan-China dependencies, and just the uncertainty around future rules, like whatever replaces the AI diffusion IFR. It's clearly top of mind.
Okay, export controls are a big one. What else? Supply chain and demand forecasting.
Yes, that's another major theme. They talk about manufacturing lead times being really long, like 12 months or even more. And that makes it incredibly difficult to accurately predict demand way out in the future, especially when demand is affected by so many things. Product cycles, competition, macroeconomics, new use cases popping up. They even mention crypto mining as a historical example, and even things like data center construction delays or energy availability impacting customers.
Yeah.
So this mismatch between long lead times and volatile demand creates this risk of either ending up with too much inventory, hence provisions like the $1.9 billion H20 charge we saw, or not having enough supply when demand surges, which can hurt revenue and margins too.
And managing their own rapid innovation. Does that come up as a challenge?
It does. They note that introducing new products more frequently and with increasing complexity, especially their plan for a new data center architecture, basically every year brings its own hurdles. Managing supply and demand during those transitions is tricky. It can affect demand for older products, and there's always a risk of initial quality issues with brand new complex systems.
Competition is always a factor too, I assume.
Yep, listed as a key risk, not just from direct competitors, but they specifically mention the potential threat if widely used open source AI models become optimized to run better on rivals' hardware. That could weaken their platform's pull. And also the risk of large customers deciding to develop more of their own custom AI chips internally.
Makes sense. And finally, the usual macroeconomic suspects.
They list them out. Tariffs, inflation, interest rates, general supply chain issues, geopolitical events, all the things that can impact costs, spending, supply chains, even the value of their investments. Standard list, but still relevant risks.
Okay, wow. That really covers a lot, from the huge growth to the very significant challenges they're highlighting themselves. Let's try to wrap this deep dive up.
Sure. So, quick recap based on these documents. Q1 FY26 showed continued, really exceptional top-line growth, driven almost entirely by data center demand. However, that JAP gross margin took a significant hit, mainly from that big H20 inventory charge. Operationally, they're still investing heavily in R&D, generated massive cash flow, and returned a lot of capital to shareholders.
Right. But, and this is a big but coming directly from their filings, they are clearly navigating some major external headwinds. Those export controls stand out as a complex, uncertain, and already impactful factor affecting their near-term forecast.
Absolutely. And alongside that, the challenges of supply chain volatility, trying to predict demand for bleeding-edge tech years out, and just managing the complexity of their own rapid innovation cycle are all highlighted as significant ongoing risks.
So, Stepping back from this deep dive, you look at the incredible AI-driven growth, but then you also see just how much space in their official financial reporting is dedicated to discussing these complex geopolitical factors and logistical uncertainties.
It really makes you think, doesn't it?
It does. And maybe a final thought for you, the listener, to consider, drawn purely from the emphasis in these documents. Despite achieving this phenomenal technological success, what does it tell us about the unique operating environment today when a company like Nvidia spends so much time in its financial reports discussing global policy, export rules, and supply chain logistics? It seems almost as critical as the tech innovation itself.
Yeah, a lot to chew on there about the intersection of tech, policy, and global markets.
Indeed. Well, thank you for joining us for this deep dive into Nvidia's Q1 FY26 results, pulled straight from their own commentary and filings. We hope breaking it down this way provided some valuable insights into their performance and the landscape they're navigating.